Welcome back, everyone. Today we're going over Section 6, an introduction to technical analysis. For the last section, we went over fundamental analysis. That's to be used if you're a long-term investor. Technical analysis is what you want to use if you're a short-term trader. Let's get the disclaimers out of the way. We're not your financial advisors. We're not here to give you specific investment advice. We are here to give you education. And any company that we do talk about today in this section is to be taken as educational and illustrative purposes only. Here's the best quote for traders. The trend is your friend. And today we're going to cover the following topics. What is technical analysis? We're going to show you how to spot trends for short-term trading. We're going to show you what higher highs and higher lows are compared to lower highs and lower lows. Then we're going to get into some of the important indicators that we use, starting with the moving average, stochastics, the relative strength index, the Williams percent R, and then finally the moving average, convergence, divergence, also known as the MACD. And we're going to show you how to use the arrows in conjunction with these indicators, and we're going to wrap up the section by going over support and resistance. Technical analysis is a trading strategy used to evaluate and identify trading opportunities by analyzing short to midterm trends, usually daily to weekly, gathered from trading activity and indicators found on a stock chart. Unlike fundamental analysis, where investors look at a company's financial data to determine its financial strength and intrinsic value, investors who use technical analysis look at charting patterns to evaluate a stock's current strength or weakness. In layman's terms, technical analysis looks at a company's stock chart to determine a current trend. This helps traders determine when to buy and when to sell. There are literally dozens of indicators, tools, etc. that you can use as a technical analysis trader, and we dive into these much deeper in the Technical Analysis Bootcamp course. In this section, we'll share with you some of the most common tools. In Section 5, we gave you an overview of fundamental analysis. This involves finding financially sound businesses that we can invest in for the long term. Once we identify that business, the next step is to buy the stock once it's available at a discount to fair value, and we sit back and wait for that stock to go back up to its true intrinsic value. The hard work is done in the beginning when you do your in-depth research. Once that research is complete, and now you own the security, very little is required to manage the position while you own it. Ideally, you want to own it for several months or even years. Fundamental analysis is for long-term investors. However, technical analysis is quite the opposite. This is going to be for short-term traders. First off, the strategy is much more time-consuming. This isn't a good thing or a bad thing, it's just something to be aware of. Since this is short-term, days to weeks, sometimes even months, you need to constantly watch the charts to find new opportunities and to monitor existing positions to see if a reversal is happening. You can never just sit back and relax and hope that your trade is working out. Next, there are several indicators to use, patterns and signals to look for, etc. You need to find those that work for you. Not every tool is going to be valuable to you. Why do we do all this work? Short-term trading can be very lucrative. That's why so many people are attracted to this style of investing, even though it's very time-consuming. If done correctly, the short-term trading is a beautiful complement to long-term investing. Short-term profits can have a huge compounding effect on your total portfolio returns. Another reason why we do this is simple. As traders, we can profit in any market condition. As a long-term investor, we make our money when the stocks we invest in go up in value. As a short-term trader, there are trades designed to profit if the market is in an uptrend. There are also trades we can take advantage of if the market is in a downtrend, and there are even trades designed to profit if the market is trending sideways. Trading offers many opportunities. However, it can also be very risky. By employing some of the tools in this section, you're going to be removing a lot of the risk associated with short-term trading. And there's a phrase that we all use when it comes to trading, and it's very important. That's why we started this section off with the quote. The trend is your friend. You want to trade with the trend. Trading in its most simple form is summed up by this phrase. If you place your trades in the direction in which the trend is going, you'll be putting many of the odds in your favor. If you trade against the trend, it's like trying to swim upstream without a paddle. Trading is hard enough as it is. Don't make it any harder than it has to be. Therefore, we're going to trade with the trend. If the market sector or company that you're trading is in an uptrend, this is when you should be buying. If it's in a downtrend, you're either going to use bear market options trading strategies or you're going to sell short. Selling short, as you'll learn in Section 4, is when you profit from a decline in the market, sector, or company that you're trading. Being able to clearly define current trend enables you to follow the dominant direction of a stock's price movement. Identifying and trading a particular trend is one way successful traders put probabilities on their side. And there's three types of trends that we can identify: an uptrend, a downtrend, and a sideways trend. Higher highs and higher lows. A trend is determined by analyzing a stock's price on a chart. And an uptrend can be seen when a stock has higher highs and higher lows. So if we take a look at this chart right here, the stock is coming up and it hits a high before it has a little bit of a pullback. Then it comes back up. And what we see here is this high is higher than the previous high. Then it comes back down a little bit, and this low is higher than the previous low. Then it goes back up again. This high is higher than the previous two highs. And once it pulls back, you have another higher low. So this low is higher than these two, and so on and so forth. Very rarely, if ever, does the stock go straight up. They usually go up, then they come down, then they go back up again. As you can see in the previous chart, an uptrend is identified when the current high price is trading at a price that's higher than the previous high price. And when it pulls back down, the lows are higher than the previous pullback. A downtrend is quite the opposite. This can be confirmed when you see lower highs and lower lows on a stock chart. So come over here, you see the stock coming down, it hits a low. The stock isn't going to crash all the way to the bottom at once. It's going to fall down like it did right here. Then it's going to come up a little bit. Then it's going to fall again. And what we see here, this low is lower than this low. And it comes back up just a hair. And this high is lower than the previous high. And you have another drop, which gives us another lower low than the previous two lows. And then so on and so forth. Another high, which is lower than these two highs. That's a lower low and a lower high. As you can see in that chart, the stock started to fall. As it was falling, it came back up a few times before falling even more. When the stock falls lower than the previous drop, that's considered a lower low. Each time it rebounded, the high stock price was lower than the previous high price. That's considered a lower high. Lower lows and lower highs are seen in an obvious downtrend. A sideways trend occurs when the stock trades in the same range. The highs are about the same as previous highs. The lows are about the same as previous lows. Since this is an intro to technical analysis, we're going to give you a brief overview of a few of the more basic indicators that we use to identify current trends. For more detailed information on these indicators, as well as information on the more complex tools that we use, log into the Technical Analysis Bootcamp course. It's available to all of our students, but please make sure that you take all the courses in the chronological order that we put in place. We want you to understand the basics before jumping into the advanced content. The first trend spotting tool we're going to use is called the moving average. This is the average price of a stock over a specific period of time. The overall idea is to show whether a stock is trending upward or downward. This is a lagging trend following indicator that smooths out price action based on past prices. If you're going to be buying stock or using bull market option trades, a good candidate will have a moving average that's sloping upward. If you're looking for a good stock to sell short, or if you're going to do a bear market options trade, you generally want to find one with a moving average that's flattening out or declining. And the most common time frames that we use are the 10-day moving average, the 20-day, 30, 50, 100, and 200-day moving average. Keep in mind, the longer the time frame, the greater the lag. The longer-term moving averages are used for long-term investors, and shorter-term moving averages are used for short-term traders. When looking at a stock chart, a downtrend occurs when the stock price closes below the moving average line, as seen here with the red arrow, and an uptrend occurs when the stock price closes above the moving average, which is the red line, as seen here with the green arrows. Let me show you something here. These bars represent where the stock opened and closed at for that trading day. A red bar is when the market closed negative for the day, or the stock closed down for the day, and these clear white bars is when the market or the particular security closed up for the day. And so with the red bars, this line shows you where the security opened up at, and this shows you the high for the day, this shows you the low for the day, and right here at the bottom of the bar, that's where the market closed. With the white bars, it opened up here, and since it was a positive day, it closed up here. and here you have a down day, an up day, a down day. And if you see here, this closed below the moving average line, which is the red line. This day right here where the market closed up, it closed really close to that red moving average line, but didn't close above it. Next day closed below the line. Here closed below the red line. Closed below the red line. But then right here, we finally see the market open up here. It closed here, which is above that moving average line. That indicated that a positive trend reversal is in place. That triggered a green or a positive arrow. And now the market is above the moving average. So here we had an up day, and it's above this red moving average line. This day right here closed negative, however, still above the moving average line. We had a couple up days, and then things start coming down a little bit. It fell here, but didn't close below the moving average line, so no arrow was triggered. We had an up day, and finally here we have a down day. The market or the security opened here, and then it closed right here, which happens to be below the moving average line. That triggered a red arrow, which is right there. And we have a couple days where it's below the moving average line, and finally we have another day where it closes above the moving average line, and that's going to trigger a positive green arrow. When a stock is trending up, it's going to spend a good amount of time above the red moving average line. A good entry signal exists when a stock crosses over and above the moving average line as seen in that previous chart. A good exit signal exists when a stock crosses over and below the moving average line. When a stock is trending down, it will spend a good amount of time below that red moving average line. A good entry signal for bear market strategies and shorting exists when the stock crosses over and below the moving average line as seen in the previous chart. And a good exit signal exists for bearish trades when the stock crosses over and above the moving average line. Next is stochastics. This is a measure of a stock's bullish or bearish sentiment. This tells us if the buyers, also known as the bulls, or sellers, also known as the bears, are dictating current trading in the stock. The stochastic oscillator is a momentum indicator comparing the closing price of a security to the range of its prices over a certain period of time. Stochastics play a role in identifying overbought and oversold levels because it's range bound. This range goes from 0 to 100. And it's going to remain constant no matter how quickly or slowly a security advances or declines. We want to see if the current trend is in the upper percentile, lower percentile, or if the stock is trading near the middle of this range. The math behind the indicator looks at the highest price and the lowest price the stock has traded in the last 14 trading days, which is approximately 3 trading weeks. This process determines a trading range. The current position of the stochastics tell you where the current price is in relationship to the 0 to 100 range. Considering the most traditional settings for the oscillator, 20 and lower is typically considered the oversold or bearish threshold. This means that the bears are in control and driving the price of the stock down. Readings below 20 indicate the security is trading near the bottom of its high-low range. At a reading of 20, it is in the bottom 20th percentile of its recent trading range. And just because the stock is oversold does not mean there are no more sellers. This oversold territory can last for quite some time. It just means that the sellers are in control of where the stock is currently trading. Do not buy just because the stock has hit a bottom. And later, you're going to learn to use this indicator in conjunction with the other indicators to give us confirmation that a downtrend has ended. And when the reading reaches 80 or higher, it's considered in the overbought, the bullish threshold. This means that the bulls are in control and driving the price of the stock up. Readings above 80 indicate a security is trading near the top of its high-low range. At a reading of 80, it's in the upper 80th percentile of its recent trading range. Just because the stock is overbought does not mean there are no more buyers. This overbought territory can last for quite some time. It just means that buyers are in control of where the stock is currently trading. And we're not going to sell just because the stock has hit a high. We're going to use all the tools together when making our buy-sell decisions. Here's a chart showing the stochastic indicator. A reading above 80 is overbought, shown with the red arrow, and a reading under 20 is oversold, shown with the green arrows. So right here it's oversold, it crosses below this line, and it's oversold for some time, and then once it crosses back up, you get the positive indicator that a trend is reversing upward. So comes up for quite some time, and now it's overbought. And when it's overbought, it crosses below this line, you get the red arrow. And it comes back down, and it's oversold, and after being oversold, it's going to cross above this line right here, triggering a positive green arrow. Another momentum indicator that we like to use is the Relative Strength Index, also known as the RSI. RSI measures the degree of recent price changes to analyze overbought or oversold conditions. Similar to stochastics, this indicator is primarily used to attempt to identify overbought or oversold conditions in a security. And when putting this indicator on your custom chart, select the 14-day time period. Using the scale of 0 to 100, we interpret a reading of 80 or higher as an overbought signal. When a security is overbought, also referred to as overvalued, we are anticipating a trend reversal to the downside, also known as a pullback. Some traders use a reading of 70 as an overbought signal, but we have found that this lower level creates a lot of false signals. A more accurate reading comes when we wait for it to hit 80 or higher. When RSI falls to a reading of 20 or below, we interpret that as an oversold or undervalued condition. At this level, we're anticipating a trend reversal to the upside or a corrective price reversal to the upside. Some traders use a reading of 30 as an oversold signal, but what we have found is that this also creates a lot of false signals. So we want a more accurate reading, and that comes when we wait for it to hit 20 or lower. RSI can be used with stochastics or in place of stochastics. The RSI is often used in conjunction with trend lines such as support and resistance, which you will be introduced to later in this section. The Williams %R indicator is also a momentum indicator, similar to stochastics and relative strength index. This indicator measures overbought and oversold levels and is used to establish entry and exit points in a position. It compares the closing stock price of each day to the high-low range over a period of time. Now, I use the default time period here, which is also 14 days. The Williams %R is a popular indicator because of its remarkable ability to signal a market reversal at least one or two time periods in the future. And this oscillates between 0 to negative 100. When the indicator produces readings from 0 to negative 20, this indicates overbought market conditions, and we don't buy when it's overbought. We do use this to get into a bearish trade. When the readings are negative 80 to negative 100, this indicates oversold market conditions. When it hits readings of negative 80 to negative 100, it could indicate a time to get into a company that you're analyzing or doing a bullish trade. This chart shows how a stock performed after being oversold at negative 80 and how it performed after being overbought at negative 20. So what we see right here, the stock was very oversold. It is well below negative 80. And if you take a look at where the stock performed right around that same time period, it went from about $57 a share and it shot all the way up close to $65, $66. Then you got the red star because it hit overbought territory at negative 20. And when the stock was overbought, it came down a little bit, had a nice pullback, and then it was overbought again. And this time when it was overbought, it fell from about $66 a share all the way down here to about 58. And that's where it was oversold. So this star here shows it was oversold, and the stock went back up from about 58, 59 up to 65. Fell again, it hit oversold territory, and the stock appreciated quite nicely. This shows you the relationship between an oversold and an overbought indicator and how the stock coincides with that. As great as this indicator is, it should not be used as a standalone indicator. We only enter into a bullish position when we see that a majority of indicators turn positive at roughly the same time. We're never going to act on just one indicator. If a majority of these indicators turn negative at roughly the same time, we're going to enter into a bearish trade. The last indicator that we use is called the MACD, which stands for Moving Average, Convergence, Divergence. This is a trend following indicator, and this shows the relationship between two moving averages of prices. The MACD is a combination of a fast-moving average and a slow-moving average and how they interact together by converging and diverging. All the indicators that we use, this one tends to give us the most signals, such as the red and green arrows, which you're going to learn in a moment. Since this reacts the quickest to price changes, the MACD tends to be the first of the indicators to give us a buy or sell signal. We use the MACD as an early warning indicator to alert us of potential swings in momentum in the trading days to come. Those potential swings in momentum are confirmed using the other indicators, which are momentum and lagging indicators. As shown on the next chart, when the MACD falls below the zero signal line, it's a bear signal, which indicates that it may be time to sell if we are long a position. Conversely, when the MACD rises above the zero signal line, the indicator gives us a bullish signal, and this suggests that the price of an asset is likely to experience upward momentum. And here's a chart for the MACD. The moving average, stochastics, relative strength index, Williams percent R, and the MACD are all very good indicators. However, as great as they are, we can't rely on just one of these indicators alone, since some are momentum indicators while others are lagging indicators. For the most accurate results, they must be used all together. We use them all together by creating a custom chart that has all 5 indicators on there. Once we create our chart, we're going to use a tool called the arrows. If you're using a charting program such as Thinkorswim through TD Ameritrade, you can put these indicators on your charts and customize the view however you want to see it. The arrows let you know when the stock price has crossed the parameters for each indicator. For bullish trades, you want to act when 4 out of the 5 indicators turn positive at roughly the same time. This is represented by the green arrows. What I mean by that is if you get a green arrow on the stochastics today and the other 3 tomorrow, then that's a good buy sign indicator. If you get a green stochastic or a green Williams percent R today, next week you get the moving average that turns green. The week after that you get the MACD or the RSI that turns green. That reading is not as accurate because there's too much time in between the first and the last indicator. For the best results, this has to occur at roughly the same time, ideally the same week. And also be aware of false signals. If you get a green arrow, followed by another green arrow, and then suddenly get a red arrow, that's a false buy sign. That cancels everything out. We want 4 of the 5 green arrows in a close time frame with 0 red arrows in between. And for bearish trades, we want to see the exact opposite. A great bearish indicator occurs when 4 of the 5 indicators turn red at roughly the same time with 0 green arrows in between. Use a 1 or 2 year chart and use the daily or weekly time frames. Do not buy just because one indicator goes green or sell when one indicator goes red. Use them all together for the best results. And this chart shows that we got 4 out of 5 indicators that turned green at roughly the same time. And what happened was the stock went from about $82 a share all the way up to $140, I believe that is. So this is a perfect example of how the arrows work really well. Another technical indicator that I use is called support and resistance. Some people call these tops and bottoms. They're also known as floors and ceilings. Support, which is also the bottoms or the floors, this is a level where the price tends to find support as it falls down. This means the price is more likely to bounce off of this floor rather than break through it. If it bounces off of this level, this is a great time to place a bullish trade as the stock is in an upward trend. Once it hits this support level, wait 1 or 2 trading days for confirmation that it has bounced up off the support level. And here's DIA. This is the Dow Jones Industrial Average Index Fund. And here it comes falling down, close to hitting the floor. Comes back up, comes back, hits the bottom one more time, comes back up, hits the support right here, and bounces back up. 3 times it hit support and bounced up. However, once the price has breached this level, it's likely to continue falling until meeting another support level. Once it hits support level, wait 1 or 2 days for confirmation that it has fallen through support. If it does fall through support, you're going to see red arrows, and this is a great time to place a bearish trade or short the stock as the stock is poised to drop in price. So here, take a look at Facebook. If you pull this yellow line over a little further, you'll see that it did hit support right here, came up, hit support again, came back up, hit support again, came up, and then it hit support, and finally this time it broke through it, and after 1 or 2 trading days, it confirmed it's in a downtrend, and the stock went from 170 down to right around 150, 155. Resistance level. This level, also known as tops or ceilings, is the opposite of support. It's where the price tends to find resistance as it rises. This means the price is more likely to bounce off of this level rather than break through it. If it bounces off of this level, this is a great time to place a bearish trade as the stock is now going to be in a downward trend. Once it hits a resistance level, wait 1 or 2 trading days for confirmation that it has bounced down off of resistance. And here's the ETF for the Russell 2000, it's IWM. And here, this is the top, ceiling, and resistance, known as all three. So it hits resistance, then it comes falling down a little bit, comes back up, and it hits that ceiling. It's not going above that ceiling. Comes back down. Almost hits the ceiling again, comes back down. Once the price has breached this level, it's likely to continue rising until meeting another resistance level. If it bounces through this level, this is a great time to place a bullish trade as the stock is now going to be in an upward trend. Once it hits the resistance level, wait 1 or 2 trading days for confirmation that it has bounced up and through resistance. Take a look at the stock again, IWM. It hits resistance, comes down, hits resistance, comes down, hits resistance, comes down. This time it hits it and then it breaks through it, which is now an upward trend. In this section, you've learned to identify trends on a chart. You've learned a few very powerful indicators, such as the moving average, stochastics, the relative strength index, the Williams percent R, and the MACD. You've learned how the arrows help to determine precise market trends by combining all these indicators together to complement each other. And lastly, you've learned how to use the trend lines to amplify your trading results. When you combine all of this together, not only are you reducing your risk, but you are going to achieve very exciting, more importantly, very consistent returns. This is an intro to technical analysis. A lot of this information might be brand new to you. So I want you to go back and watch this recording as many times as you need. For more detailed information on the topic, you can also log into the Technical Analysis Bootcamp course. And we also have a live Q&A every Friday at 12 o'clock p.m. Eastern Standard Time. It's a great time to tune in and ask any questions you may have. And we do offer one-on-one help that's available for those who need a little extra help and a more personal touch. Here's your learning activity for this section. I want you to use one of the 3 companies on your watch list and identify the current trend. Is it in an uptrend, a downtrend, or is it trending sideways? Next, I want you to look at the arrows. Do you see 4 out of 5 arrows turning green or red at approximately the same time? And then lastly, is it currently bouncing off of or through support or resistance, or is it somewhere in between? So that's it for section 6. I hope you'll learn a lot of information here. I'm looking forward to seeing you guys in section 7. Take care.